right. Okay, we'll be talking about the four unique wave pattern you will always see on gold, and you can see the same pattern on CAD CHF, BTC USDT, and GBP JPY. On these four pair, you can see them. Gold is known for a chart that or an instrument that respects zones. Gold is known as an instrument that respects zones. So it moves from zones to zones. Gold moves from zones to zones. Now let's start with the number 1 to number 4, then number 1 to number 4 again. Why I said number 1 to number 4, then another number 1 to number 4 is, in market structure, we have three types of market structure. We have the bearish move, the bullish move, and we have the what? The sideways move. So on gold, on this four wave pattern, we have what? The same thing: the bearish move, the bullish move, and what? The sideways, which is the ranging market. So now let's start with what? The bullish move. Gold moves from what? From zones to zone. So in a bullish move, market will keep what? Breaking its highs. Market will keep breaking its highs. That's when the market is what? Is in an uptrend. And in a bearish move, market will keep what? Breaking its lows. That is when the market is in what? Is in a downtrend. So let's start with what? With the bullish move. Low, then what? The high, which is now, this is now what? An impulsive move. And what do you have to see next? What? Correctional moves to correct the move, which is what? Correctional move, create another low, and what? An impulsive move that will create what? Higher high, that is higher than the previous high. And another correctional moves, what? To retest. As for gold respect zone, so it has to come back to respect this previous high. On this, like the first wave pattern, it has to come back to respect this previous height created. So correctional move to respect that zone, and what? Impulsive move that will break above or this previous higher height created, for us to have another higher high visit, another correctional moves, the impulsive move. That's how it moves. It keep breaking its highs. It keep breaking its highs. That's to tell you, okay, we are in a what? In an uptrend. That's for the first wave pattern. Whenever you see this kind of pattern in the market, like you see gold doing something like this, so if the market is currently on those points, you should expect market to reverse backward, correctional move, to retest this point and then pushes to the upside. That's that for the first wave pattern. Then now let's do the second wave pattern. This is it. A low, created a high, correctional moves, created another high, which is higher high, correctional moves to respect that same zone, then pushes up again, created what? Another higher high. Now created what? Correctional moves that respect these zones. Now, instead of it creating another higher high, it will come back to create what? Equal high. This is for the second wave pattern. It will come back to create what? Equal high. Equal high, and then another what? Correctional moves that will fit to break here. It will come back to what? Respect the same low, which is what? An equal low. And then what you should expect next is the next impulsive move should break these two high. The next impulsive move, what you should be expecting, the next impulsive move to break is too high, something like this. So this usually happen when market what? During a news session. When this pattern usually happen during news session, you will always find this kind of wave pattern either monthly time frame, weekly time frame, daily time frame, in all the time frame, including 1 minute. You find this kind of wave pattern. This is the second wave pattern. Then now the third wave pattern in a bullish trend. You see something like this: low, high, correctional moves, impulsive move that will break this one, then another correctional move that will respect this one, an impulsive move that will break this one. Then in this third wave pattern, this is what you see. Instead of it respecting this zone, this previous high it created, it will break below this previous high and come back to what this what low, this previous low. It will respect this previous low, something like this, and then pushes what to the upside. So your expectation should not be more than this recent high it created, because this usually happen when market is about to change its trend. When the market is about to change from an uptrend to a downtrend, that's when this pattern usually happen. That's when this pattern usually happen. So your target should not be more than this point. Your target should not be more than this point, because if market creates something, in most of the time when market creates something like this third wave pattern, what we see next is something like this. You see it respect this high, then you will see something like this, a new low, then another high that will not break this high, something like this. Then you now see a new low that will break this low. You see, then you see something like this, and this one will respect this low here, something like this. Then this one will start tanking down. That's how it moves. You see, that's for the third wave pattern. So it usually happens when market is about to change a trend from an uptrend to a down trend. That's that for the first, second, third, and let's draw the fourth wave pattern. This is it: a low and a high, correctional moves, another higher high, correctional move, another higher high. Now the market what created something like this. The market was supposed to respect this, but the market failed to respect this. And now it was also supposed to respect this, but the market will fail to respect this. And instead of respecting this, if it come to this point and the market will now respect this zone, which is this higher low here, the market will respect this higher low, or you can call it lower high. So respect it, this zone, then pushes on, continue to the upside. You see, for me, your target should not be more than this recent high it created. In most cases, it might break this recent high to create another higher high. But for me, you don't have to be greedy. Immediately get to this high, just hop out from the trade. So let me explain it better to your understanding before we move to the bearish move. So these are zones. These points where the market retraces, they are known as zone. Where the market gets to before they create another moves, they are known as zone. So when you are plotting your F and arrow zone, which you will know on the next class, how to plot your F and arrow zone. So these are your zone. Bring out your trend line to mark out your zone. If the market has formed this one, these impulsive moves, and now you see the market creating a correctional moves, tanking down with like 2 candles to the downside, you should mark out your zone. Mark this one out, stretch it to what? The future. Then what you do next again, wait for the market to what? Fully form its correctional moves. Then when it gets to a point here, you will see how the market will be reacting, the way it will be reacting on the lower time frame. Like maybe this whole diagram is on the higher time frame, like you've plot out your F and arrow zone on the higher time frame. Then when you go to the lower time frame, you will not see the market was starting breaking what it highs. It will start doing something like this. So on the lower time frame, you see something like this. Since it's tanking down, it will keep what breaking it low, keep breaking it low. Then when you see something like this in the lower time frame, so you can see, let me change this color. low. You see what happened here? So the market created what? A stand down. Now it created what? A low here and a new high. A low that what did not break below this recent low it created here. And it created a high that broke this recent high it created. And this high also break what this previous high here. You can see, and now it's what coming back again. What you should expect is that market should come and retest on this zone here, then continue to the upside, or market should come and retest on this zone here, this one, then continue to the upside. So this confluence is a confluence to tell you that market what is about what to end its correctional phase and then what continue its impulsive phase. So your you should target here. You should put your entry should be on this point. Then your stop loss should be below this point, and you target what this point. At first, here should be your first take profit. This point, because this is the only zone you've seen. So this is the only zone that has happened. So it should be your first take profit, and then you will be careful because you don't know what might happen in the future. So you'll be careful on what will happen as the market keep pushing to the upside. Then immediately you get 1:2 or 1:3, then you hop out from the trade. Like 1:2, 1:3, then you hop out from the what? From the trade. That's that. So now, then after this correctional moves has fully formed, you mark out your zone here again. Mark out this your zone. Then if this one has fully formed, you mark out this your zone. Then now the market is what? Creating another correctional phase. You can see the correctional phase come to the downside. What should you should expect is that market should come and what? Retest on this zone, which is this previous high. For that is for the first wave pattern. That's for the first wave pattern. Let me label it so that you see. That's for the first wave pattern. That's for the first wave pattern. That's for the first wave pattern. So the market will, as it keep pushing to the upside, it will come back to respect this its zone before tanking to the upside. But before now, you won't know that it is what trying to do the first wave pattern. So your what will now give you the confluence of all the what will give you the confidence that market what is about to change its trend from this place. Like market is done with its correctional phase, that this is the first wave pattern. It is what this kind of move. Whenever you see this kind of move, market what keep breaking its highs on the lower time frame, then you will know that, oh, market is about to what change its trend. That's when you will know that, okay, the correctional phase has ended. Now you should look for a possible means to enter for the buy. So your mind will tell you, okay, this is the first wave or pattern. And now let's move to the second wave pattern. You see how the market keep what creating its high, correctional move, impulsive move, correctional move, impulsive move. Now when the market gets to this point, you plot at your zone here. When the market gets to that point, you plot at your zone, and now it's creating a correctional move to this point. From here, a correctional move to here, and you see something like this, the example I did here, you see it here. Market start creating what? Higher high. So you entered, and you see when market get to this point and market start creating what? Lower lows. You should opt out from that trade because it seems that market is respecting this zone. So then you should mark out what? This zone. Mark out this zone. Mark out this zone. This will not be your what? Your zone. Then when market reverse back to this zone, we market reverse back to this zone, and you see market starts what? Creating higher highs. If market starts creating higher highs, then you would look for another possible entry from this point, and your target should be what? Above this point, because on the second wave pattern it says that market what will break these two equal highs it created. So that's why you are to what? To target what? Above these two highs. So your target should be above these two highs. whenever you see market keep breaking its higher highs on the lower time frame, so you target what above these two high, because market will surely break these two equal high created on the second wave pattern. You understand? That's that for that. And now let's go to what the third wave pattern. Maybe you see something like this. Market has created what impulsive, correctional, impulsive, and now you mark out your zone from this point. You've marked out your zone. So market came here, keep breaking its highs on the lower time frame and broke this high, created another higher high, and is now creating a correctional phase. You should what? Mark out your zone here again. This is your zone. Mark out your zone here to the future. Mark out your zone to the future. And you see market creating what? Correctional phase. When market gets to this point, market will refuse to create what? These higher highs on the lower time frame that will give you a confirmation that the market what is respecting this zone, which is something like this, that the market is respecting this zone. You should what? You should hold on, pause, and watch what the market is doing next. Just be patient, because patience is the key. It is your patience that will give you what win rate on in this forest phase. So when markets break below and get to this point, then you see market, when market get to this point and market starts creating higher highs from this point, you should know, okay, that's the third wave pattern. That's the third wave pattern. So you should what? Look for possible entry from here, and then what? Your target should not be more than this recent high here. Your target should not be more than this recent high, because this pattern usually happen when market is about to change its trend. You understand? Then this fourth wave pattern, it did not always happen, so it happened once in a while. This fourth wave pattern, it's rare, but you surely see it. Though it's rare, but you surely see it when trading. So now you've seen this impulsive correctional phase, impulsive correctional phase. Then you mark out what? Your zone. You mark out your zone. So now impulsive correctional phase. Market was supposed to what? Market did respect this high. You see, market, it did respect this high and pushes to the upside, created another high that broke this recent high. That broke this recent high. This for the fourth wave pattern. Then you see a correctional moves. When market get to this point, you'll be like, okay, the first wave pattern said that when market gets to here, created higher highs as you enter. If you don't see market creating higher highs here, please wait, don't enter. Just allow market to do its things, and market will start tanking down. When market get to this point, which is the third wave pattern, you see market what did not respect this zone here, you should relax. Just allow market to do its thing. And when market get to this point and you see market creating higher highs, then you should know that okay, the market is what? The correctional phase has ended. Now it's what? About to move to the upside. Your target should be this recent high. Your target should not be more than this recent high. You see market creating its higher highs and what? It pushed to the upside. That's that for the bullish bullish wave pattern. Bullish wave pattern. That's that for the bullish wave pattern. One, two, three, four. Please, it is best you understand this pattern, because these are the pattern that will give you the edge on the forex market. This pattern, if you can understand them well, you have a edge over what? The market, over the market. So because there's an assignment, I will tell you to draw this pattern for me, and I will tell you to also identify them on the chart for me. Now let's do what? That of the bearish what pattern. This is a textbook drawing, so it's not, you won't see it like clear like this on the chart. So it's a textbook drawing. Bearish, the first wave pattern. I won't do much explanation here because it is the opposite of the bullish pattern. So I've already explained all on the bullish pattern. So it is the opposite. Just carry whatever I explained there to this point, then you are good to go. So you created what? A low, pushes up, another lower low, correctional moves that came to respect this lower low it created, then impulse that break this lower low and created what? A correctional phase to give us what? A high low. It respect the previous lower low and then what? Tank down. That's that for the first wave pattern. That's that for the first wave pattern. Then the second wave pattern, a high, a low, higher low, lower low, higher low that respect the previous higher low, and a lower low again, higher low that respect the previous lower low, and instead of this broken below this lower low, it respects it and came back to respect what? This what? Higher low here. Then what do you see? A boom to the downside that broke what? This equal low it created. That's that for the second wave pattern. Then the third wave pattern, a high, a low, a correctional phase that created what? A higher low, an impulsive phase that created a lower low, correctional phase that came back to respect this higher low like this, an impulsive move again. And this, instead of this respecting this lower low, it would come back toward this higher low. Then it respect it like this, and then what? Your target should not be more than this recent lower low here. This should be your target. That's that for the third wave pattern. And the fourth wave pattern is like this. Please, if you don't understand anything, please keep your question, come to the live session, and I will answer all your questions. Just keep your question, come to the live session, and I will answer all your question. There is it. Impulsive move, correctional, impulsive. Now, correctional. It was supposed to respect this, but it failed to respect this. For the fourth wave pattern, now it was supposed to respect this, but it failed to respect this. It came back to what? This what? This higher low here. It respects it, and your target should not be more than this. Your target should not be more than this. You see. Let me label them. One first wave pattern, then second wave pattern, third wave pattern, then fourth wave pattern. So let me mark out the zones. These are the zones. You see our market keep respecting the zone. These are the zones. So these are the zones. Market will keep respecting the zones. Gold is known for that. That is a chart or is an instrument that respects zones a lot. You see our market keep respecting the zones. You see. You see how the market keep respecting its zones. I've done all the explanation for this. So just take the explanation I did on the bullish trend, take it down to this downtrend. Remember, if you want to know that the market is about to change, like the correctional phase is coming to an end, this is what you should see on that zone. Let me do this again. This is what you should see in a lower time, which is the bearish move, in the bearish structure, or in a downtrend. When the market has created these impulsive moves to this part, and now it is not creating correctional phase, for you to know that the correctional phase is about to come to an end, this is what you should see. Because when the market is tanking, okay, to keep at first, the correctional phase is something like this, keep breaking what it hides, something like this. Then with the market stops there and what created what a new high and a low that refused to break there, and created a high that broke this one and created this low. So you should look for possible means to enter, because what you should see next is an impulsive move to the upside. Let me change the color so that you see it clearly. You see it? So it will keep what creating a high. It will keep creating. So the reason why I'm drawing this zone should be like lower time frame zone. So the reason why I'm plotting this zone so that you understand it better. There's a zone here. There's a zone here. Thank you, Jesus. You see what market did when market was tanking to the upside. You see how it keep creating its higher highs, like higher highs, you see. Then immediately market was about to change its trend, like the end of the correctional phase. You see how it created what this was the high here. It created what a low and then equal high. In most cases, it will create what higher high, but in most cases it will create what equal high. In some case, it will create what uh, uh, a lower high there, because remember we said that W pattern is in three phase. W pattern is in three phase. If you understand how to draw that chart pattern very well, or if you can recognize it, you know what I'm talking about. The M pattern is in three phase and the W pattern is in three phase. So it might create what the first phase of the M pattern, or the second phase, or the third phase of the W pattern, or it might create what head and shoulder pattern, or triple top, something like that. So all these things you should know them, because you will always see them in the market. So then now it created this high, new high, this new high, then tank up again and created what another high that broke this one and broke this one. You understand? And then it created a low. So your entry, if this low did not break this low, then you should look for a possible means to enter here, because the next move you will see is what a push to the upside, which is the impulsive moves. The impulsive move. Then your first target should be this one. This should be your first target, and then what to the future, which is your second target. Then if you see another, if it create this one and you see another on the lower time frame, you see market keep breaking it high, you should know that what market, what this impulsive move has come to an end. It's not creating a correctional phase that will come back to what to retest this zone before tanking to the downside again. You understand? So that's that for the bearish move. Bearish for the bearish wave pattern. That's that for the bearish wave pattern. Now let's go to the chart where we can find them, possibly find them, then mark them out, which is the first wave pattern, the second wave pattern, the third wave pattern, and the fourth wave pattern. Let's go to the chart. This is the chart. So let's figure out the three wave pattern
which is the 4-wave pattern on downtrend, and what, in an uptrend. So this first wave pattern in a bullish trend, this is it. This is the low, created a high, another low, a high, another low, a high, another low, a high, another low. Then you see how it keep going to the upside, it keep breaking its highs. You see how it keep breaking its highs. So you see how it keep breaking its highs and creating what, lower highs. You see how it keep breaking its highs. Now when market was about to change its trend, you see what market did. Market broke what, this low, first low broken. Now it came back to break this second low again. You see, and then what, created what, a correctional phase that came back to retest this one, this point, that came back to retest it, and then what, an impulsive move again. You see, this is the now the first wave pattern. This is the first wave pattern in the downtrend. You see, I keep creating what, lower lows. And inside this first wave pattern, you also see what, the second wave pattern in a downtrend. This is it. It pulled down to respect this low here. It pulled down to respect this low, and it came back what, to respect what, this one. You see, and then what, an impulsive move that broke this what, to equal low. That's the second what, wave pattern in a downtrend. Then what, another correctional phase. Then what, impulsive moves. You know, the second wave pattern is that when market pushes down, and this one, correctional phase, on a norm, on the first wave pattern, this one was supposed to break this one, but now the market failed to break it, and it created another correctional phase what, that respect the same zone, and then what, continue tanking to the downside. You understand? So we've seen the first wave pattern in a bearish movement, which is this, what the market is doing here. This is the first wave pattern. And in a bullish movement, this is the first wave pattern. And the second wave pattern in a what, a bearish what, movement. So now this is the fourth wave pattern. I spot the fourth wave pattern here. This is on 4-hour time frame. This is the fourth wave pattern. You see what market did here. It created this high, a low, another high, a low, and created what, higher high. This market was supposed to respect this high. The market was supposed to respect this high, but the market failed to respect this high. Now the market is also what, was supposed to respect this low, and the market was failed to respect the low. It broke below it and came backward to respect this low here. You see what market, it came back to respect this low, and what, it moved to the upside and started creating the first wave pattern, push again, and then started consolidating. You can call this consolidation because giving us 1, 2, 3, 4 equal high. So this whole period is called consolidation from year to year. So immediately the market break out of this consolidation, you can start selling or start buying. See what market did when market break out of that consolidation period. See what the market did. You see, immediately market broke from this consolidation time. It was sell down 1, 2. You see, from year to year is about like 200 to 300 pips, if I'm not mistaken, or 150 pips. That's a huge money before the market created a high and a low, and start breaking its highs. Then we see what, higher highs. You get it? Now this is the first wave pattern, and then the second wave pattern. This is even the third wave pattern in a bullish move. You can see This is a zone. There's a zone here. A zone here. A zone here. So immediately the market broke above this zone. So the market was supposed to what, to respect this zone and push to the upside. Like, it has respected this zone. So now it's coming down. It was supposed to respect this zone before what, pushing to the upside. But what market did, it fails to respect this zone. It came back to this point and it broke below the point a little bit before what, tanking to the upside. Then what do you see? Boom, keep tanking up. That's how the market moves. It respects zones a lot. Gold respect zones a lot. Gold respect zones a lot. See what it did here? The first wave pattern in a bearish moves. Now it fails to respect to pull out of this. You can also see the second wave pattern here. So you created this low, high, low, lower high, then what? An equal what, lower low here. Then pushes to the upside to form what? Equal higher low here. And then what? A break to what? To the downside. This is the second wave pattern in a what? In a bearish what? Move. Now let's look for the third wave pattern. Third wave pattern. We can't see it now because we've recorded a lot of minutes. This is over 30 minutes now. So I don't want the class to take much time. So you can just find it because I will surely give you a test from it. Immediately you pass this test or this exam, then you will move toward to the next class. So master the wave pattern, master it so that you'll be able to identify it on the chart because it will always give you an edge over what the chart. It will give you an edge whenever you are trading. Whenever you see it, okay, you will know that okay, the market is what moving to the next zone. Because at first, when you open the chart, what you have to look at for is where are we? That should be your mindset. Okay, where are we? Now, if you've plot this your zone here, if for example this whole part is yet to be formed, this whole part, like this whole part from this point to this point is yet to be formed, and now you mark out your zone here. This your zone. You mark out this your zone. So you'll be like, remember this is what a reversal pattern. So the market mind, this is a reversal pattern. You get to know it or understand it better when we get to how to plot what your F and arrow zone. So the market is supposed to 80 or 60% of the time the market respect this place before moving to the upside. It respect this zone before tanking to the upside. So when you see this move, where are we now? So it says what? We are what? In a what? Impulsive move. This one is the impulsive move. And what the market now did this, which is the correctional phase. Then what you should expect what? Another impulsive what? Move to the upside. And what the market did, it created this impulsive move that almost get to this zone. And then what? If you see it get to the what? The weak of that zone. You see, it get to the weak of the zone. Correctional that almost get to the weak of the zone and then what pushes to the upside, impulsive moves, and did what this one, correctional what moves, and then pushes what almost broke this one. It came to respect it and then what gave us what a weak down that came to respect this zone. So this is a what, this is a continuation pattern. You see, the market what came back to respect this zone. Let me delete this. This right. You see the market what? It gave us a week that came to respect this zone and then what? Start tanking to the upside. That's just it. If you can master this, I will not use the word master. Let me use the word understand it very well. If you can understand it very well, you have what? An edge over the market. You have an edge over the market. That's that for that. See you in the next class where we'll be talking about what? How to mark out your F and arrow zone. See you in the next class.